Good day, friends. My name is Jason Buttke, and today we will be discussing the overarching concepts of financial management accounting and the systems involved. My hope is to give you a better understanding of these concepts that go along with this subject. Today we will be discussing accounting ethics and why these are important in the accounting field. From there, we will move on to the accounting cycle and explain what that entails, as well as the differences between for-profit businesses from those of nonprofit. After that, we will discuss financial statements, basically describing what those are and how different businesses use them in different ways. Next, we will cover cost management systems to include cost drivers and how you can use those to make better financial business decisions. Lastly, we will discuss accounting systems, which will include why these are important. We will briefly talk about the double booking method and again how accounting systems help in the financial decision making. Let's begin now with accounting ethics. Like most practices out there, along with real-life applications, ethics are the key to trust and accountability, whether that be with your boss, friend, or family members. A lack of ethics in society decreases the ability for those around you to trust your decisions and the work that you produce. With most professional organizations, there are standards that must be met to ensure rules are being met while achieving goals. Accounting is no different. GAAP, or Generally Accepted Accounting Principles, are established concepts, objectives, and conventions that help accountants determine how financial statements are prepared. Furthermore, GAAP standardizes these documents so that all establishments are using a common method of preparation. It is important to understand that GAAP is not a law, but rather a highly suggested set of guidelines to follow. By utilizing GAAP, you can help to mitigate any unethical decision-making dilemmas you might be facing. Now that we have an understanding on ethics, let's move on to the accounting cycle. The accounting cycle is a continuous process that starts with analyzing and finishes with finalizing before it starts again with analyzing. As you can see, there are 9 total steps in the accounting process. Each step has equal importance throughout the cycle. In most cases, these steps are not interchangeable and must be completed in order to maintain effectiveness and efficiency. The accounting cycle is ran continuously by businesses and helps to close out books on whatever cycle the company operates on, whether that be monthly, quarterly, or annually. Not all types of businesses operate on the same accounting cycle though. Next, we will discuss the difference between for-profit companies from those of a nonprofit. Here is a nice chart I was able to find on the internet that depicts a really good picture of the differences in profit versus nonprofit entities. One of the things that I'd like to direct your attention to is the very bottom where it shows money earned over and above, or what would be your profit. In a profit organization, this is in fact your profit, and those funds would be transferred to a capital account, whereas in a nonprofit, this excess is known as a surplus. Like the profit organization, the nonprofit transfers this to a capital fund as well. However, I think it's important to focus in on the word surplus versus profit in this case. As we mentioned earlier, the accounting cycle helps to prepare our financial statements. We will now talk about those a little more in depth. Financial statements help a business determine their overall health. These statements can help managers as well as stakeholders identify positive and negative trends within a company. Typically, these statements are released annually depending on the fiscal calendar of the company. The first document is the income statement. The income statement lists the revenues and expenses of the company. Revenue is the money that is created from operations, while expenses are the costs associated or incurred associated with earning revenue. The amount of net income on this document is also found on the statement of cash flows. The balance sheet has the elements of the accounting equation assets equals liabilities plus shareholders' equity. Assets are either current or fixed. Current assets are those assets easily converted to cash, while fixed assets are more long-termed. Liabilities work in the same manner. The statement of cash flows will show the amount of cash that a company has. Anything that affects the cash balance will be displayed on this document. The 3 areas that involve cash are operating, investing, and financing activities. The statement of shareholders' equity may also be referred to as the statement of retained earnings. This document shows the changes in shareholders' equity account. Also listed on this form will be the common and preferred stocks to include the quantity and the cash value of all stocks. You will also find the retained earnings amount that is also found on the balance sheet and the net income from the income statement. The ending balance on this form is a combination of all stock values and the retained earnings value added together to give you the total shareholders' equity. Because each type of business could consist of a different aspect, some of these financial documents could differ. When we consider the three types of businesses, that being manufacturing, service, and merchandising, you can understand how these might differ. For example, a service company probably doesn't have to account for an inventory like that of a merchandising company. The statement that will most be affected by this is the balance sheet, where inventory is accounted for. So how do we maximize these financial statements? That's where the cost management system comes into play. The cost management system is a collection of tools and techniques that identifies how decisions affect costs. It provides us with cost information for strategic management decisions and also for operational control. Lastly, it's a measure of inventory and cost of goods sold for financial reports that will eventually be distributed to investors, creditors, and external shareholders. Cost drivers are any activity or event that causes a business to incur cost. Managers or owners can help with cost drivers by using a continuous cycle as depicted. By identifying cost drivers, investigating these, determining the cost driver correlation, and then analyzing the management control effect, managers can help choose the right cost driver that can positively affect the company. Fixed and variable costs are two types of expenses in business. Fixed costs are those costs that you must pay regardless of the product or service you provide. A variable cost is related to sales volume. As sales go up, so do variable costs. One way for a company to save money is to analyze and reduce its variable costs. By analyzing cost drivers and also fixed and variable costs, managers can help reduce expenses within a company, which will ultimately increase profits. So how do we track all these cost drivers and fixed costs? Luckily for us, we have accounting systems to assist us. Having a good accounting system is vital for any company or business owner. Without accounting systems, you risk the chance at errors and lost profits for your company. A good accounting system allows for you to focus on the aspects of your business that need it most while making life much easier for you. Additionally, you will be able to better evaluate the performance of your business. This will allow you to see if your company is growing, shrinking, or staying the same. Double booking, or double entry, is used to ensure accounts are balanced. For every entry in accounting, two accounts will be affected. The double entry has two sides that are equal and correspond to each other. These are known as the credit and the debit. When we discussed the balance sheet earlier, you can see that the credits for a business should always equal the debits. Having a good accounting system will empower managers to assess the overall health of their company. These tools are very powerful weapons in the business world. Like a real tangible weapon, knowing how to use these correctly will advance your goals. However, if you mishandle the weapon, you could lose out on valuable information which could ultimately hurt your business. Today we discussed all aspects of financial accounting. We started by discussing ethics and how GAAP helps us make better decisions. Next, we discussed the ever-revolving process known as the accounting cycle and how it helps us in preparing our financial statements. We then covered the four main financial statements and how each one was different and how it can benefit us in making better business decisions. Next, we talked about the cost management system to include cost drivers and fixed and variable costs. Remember, by analyzing these expenses, you could potentially save your business valuable money while increasing your profits. We finished today by covering accounting systems and how they benefit companies. They take away a lot of the human error aspects that could potentially cost your company money or get you in trouble by overstating your business. Again, having a working accounting system can provide those in charge with valuable information to help them make better decisions. You should now have a better understanding of financial accounting. The last slide has all the references I used to create this presentation. Thank you, and I hope you have a great day.